All right, for those watching live, we know it's July 14th, 2015. This is a takeoff of an earlier session we did a couple months ago, market transitions. This one I've named Hunting for Stops, a simplistic way to look at a market. I'm going to show oil. I'm not doing any gold because it's a lot of similar chart patterns. And so a momentum market like gold and oil, right, that are less liquid, Russell, even the DAX, right, less liquid market or markets are really good for recognizing this chart pattern, but you could do it with any market. I have someone in here who says the volume is low. Is it low for everybody else? It might be on your end, Chris, where you got to turn it up on your desktop. Volume okay for everybody else? Volume is good for everybody else. So, Chris, it's got to be on your end, which you could just turn up a couple different ways. Reconnecting might work also. Remember, I'm recording it, so I'll post it later today if you miss anything. Market transitions are important because, as you'll see in that video, that YouTube video I posted, everybody has a bias, whether you know it or not. Creating a bias isn't a skill. Changing it is. All right. So when can we put ourselves in a position to change it sooner rather than later? So let's move on to a quick agenda. What we're going to cover. It's not going to be a terribly long meeting today, but we're going to go over stops. And we know stops are usually what? They're orders that exit a losing position. What does that equal? Emotion. Anytime I exit a losing position, I'm a little bit more emotional. I'm sure you guys are too. So these orders, when they're clustered, equal what? Momentum. When there's a lot of momentum, when there's a lot of stop orders clustered, there's a lot of emotion clustered, there's a lot of momentum, therefore about to surface. Short time frame or long time frame styles, it matters because you have to execute. How many times you hear me say, no matter your time frame, your style, the market you trade, you have to execute real time? So why not see where short-term guys usually will have a lot of influence on prices, and so it could make a long-term trade that you want to get in or out of. It could make it really difficult to execute it because short-term guys are pushing prices around. It could get you in at a bad spot. You get stopped out, and then it goes. There's the old saying. It's not an old saying, but it's something everybody would understand, and that is how many times you get stopped out, and then the market goes where you wanted it to go, right? So it's really important to know and understand this in watching the chart, so it becomes second nature, whether you're a short time or a long time frame type trader. The 4 questions you need to ask yourself. We're going to roll right into that on the next page to make it as easy as possible. The 4 questions are, 1, is the chart bullish or bearish? If you have to think about this question, then don't try to answer it. It has to be clear. If you just showed a 5th grader what charts stand for, if they can't answer it, then don't try to answer it. It's got to be clear to someone who is brand new to trading. Is the chart pattern bullish or bearish? It's important because if it's obvious to you, it's probably obvious to the rest of the world. If it's obvious to a 5th grader, it's probably obvious to the rest of the world that the chart is bullish or bearish. 2, if it's bullish or bearish and it's obvious, what are other traders, mostly retail traders, looking to do? Well, if a chart pattern is obviously bullish, what are most traders trying to do? Retail are the ones that we're focused on, but any trader. I don't know about you, but anything that seems bullish, you're trying to buy, right? So it's got to be obvious that the chart pattern is bullish. Then it's obvious that traders are going to try to buy it. Who cares where they're going to try to buy it at this point? The notion that they're going to try to buy a bullish chart. 3rd question, at what price are they right? And last question, at what price are they wrong? That's important because if it goes through the price that they're right, then there really is no real good predictive way to say that there's a lot of sell stops in this case, right? What do people put in after they get long? They put in sells. Above the market for a profit, below the market for a loss. Called a sell stop. Well, if their profit targets get filled, their stop loss orders get pulled. So at what price are they right, and at what price are they wrong? Now let's go to a sketch pad so I could just illustrate some of the simplicity to it. Keep it simple. It's got to be some aha moments. This is just another way to look at the same thing. So let's not use yellow. Let's go to a pen with a little more contrast here. So if the market is doing this, what does a fifth grader say if you ask him? Is it bullish or bearish, Johnny? Johnny's going to say it's bullish, right? What's Johnny going to try to do? Second question. He's going to try to buy it. Who cares where he's going to try to buy it? He's going to try to buy it, and if it's pulling back to here, and Johnny is long, Johnny is probably right if it gets above there because of this chart pattern. If it gets above the recent swing high, Johnny's going to try to get out there. Where is Johnny going to try to get out? Sell stops, probably below some sort of recent obvious swing low, whether it's there or there or there. I mean, this is a pretty odd-looking chart because it's too perfect. But that's what we're looking for. We're looking for obvious bullish charts or obvious bearish charts. Point I'm trying to make is if the market doesn't go to this X, if it doesn't go to that X, you could assure that there's somewhere in this market sell stops that are collecting and a potential transition and change in bias about to happen. Let's get rid of those drawings for a second, put in some more. So a market goes up, goes down, and it does that. And it's bullish, and it comes in there, and it's right like that. It's obvious this chart is bullish, number one. Number two, Johnny's going to try to buy it. Number three, Johnny is out above that black line, and Johnny is probably got a sell stop below there. Why do you think there's a lot of sell stops in this market? First of all, it's not, before you answer that, before you think of that answer, it's not just safe enough to say that there's a lot of sell stops below there. You have to think why there's a lot of sell stops. Because of the first two questions. The chart is obviously bullish, number one, and all the rest of the world and all the fifth graders of the world are trying to buy it and are probably long or going to get long if it ever gets down to this black line down here. They're probably going to be long because of the first question of, hey, it's a bullish chart, let's try to buy it. And everybody puts a sell stop where it's obvious. Now, if it's just a swing low, but you didn't have an obvious bullish trend up, you might not have as many sell stops. If the market goes and elects these sell stops, it usually kicks lower, and it usually is a transitional moment that the highs are temporarily in, and this market is probably going to head south because not everybody who should have had a sell stop there did have a sell stop there. In a big up move, and let's just stay on the bullish side of this example, on a bullish up move, there's always people who should have got out of a long trade and haven't yet. And more of them, the bigger the reversal. The more the people who are long who didn't get out, the bigger the reversal to the downside you'll have. This is a chart pattern that you want to start practicing seeing in markets that are moving. On a day like today where the S&P, it's July, 14th for guys watching this. Look at a chart, July 14th, 2015. If you're watching this on a recording, look at a chart of the ES. Yesterday on the 13th, today on the 14th, a thin grind type of session. Up, 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 up. You really haven't had a reversible moment or a transitional moment where the longs are nervous yet. The point I'm trying to make is that you still get more and more people buying it and trying to buy it, and so far they're getting paid. Now, With that being said, get rid of those drawings. Let's go back here and say, what's going to happen if the market goes up, comes down, goes up? It's a bullish day. You know people are trying to buy it, and the market comes down, and this is a swing low that you suspect there's sell stops underneath it. Probably there are, but then the market walks up above this swing high. Then there's probably not as many sell stops here. Why? Because the people who bought it got paid when it ran up to there. You need the market to reset and another swing low to show itself to be able to identify some obvious places. You want the questions to come quick. Is it bullish or bearish? Is it bullish or bearish? And if it's an obvious answer to you, it's obvious to the rest of the market. Not that anybody in here is too retail or too novice, but if you could quickly see it, and a better way to say it is if a fifth grader says it's bullish, the rest of the world thinks it's bullish. Everybody and their dog wants to buy a bullish market. Everybody and their dog wants to think buy when they see an obvious bullish chart. Period. So where are these guys right? But most importantly, where are they wrong? Some obvious, going back to the obvious part, what are obvious places you would get out of a long? If it's obvious that you would get out of a long there, it's obvious to the rest of the world they'd get out of a long there. You start to build a better scenario for identifying where sell stops are in this bullish example. Let me show you it on live charts. Like I said, this isn't going to be a terribly long webinar because you got to go back and look at charts and in real time try to start predicting where the stops are. Start to feel good when you say that there's sell stops below a certain price and it gets there and wham, it goes lower. That exercise and that being right will make you feel confident because you're now no longer just randomly predicting something. You're going to feel good because you used some skill you created some predictive skills. This is a chart of oil. It's a 10 reversal candlestick of crude oil. And if you just look at this market and you could say I hate to change it, but let's change it and say, let's just go to the downside now. Is this a bullish or bearish chart? The little Johnnies of the world, the fifth graders of the world would say it's bearish, Dad. So what do you think little Johnnies want to do? Get long or get short? Little Johnnies of the world want to get short. And that's fine. Let them. You guys might even want to get short, and that's fine. But at what point, at what level would you say, I no longer want to get short, or I'm going to put a buy stop to get out of that short? And if I'm going to change the pen color, but if you're not thinking and seeing a swing high like this as where there would be buy stops above, then you're not looking for the obvious. And you don't have to look to buy momentum through this at all. I'm not telling you or advocating that. Just saying that begins to start to make you think transitional moment is about to surface. So you take this chart and you get through there. This is the first moment that all the bears, all the shorts in this downward trend are saying, holy you know what. Because at no other time did a real good swing high get taken out, especially once the session was open. Because this market was weak going into this 8 o'clock open in the oil, and then it stayed weak. And this was really the first moment right in here where the shorts, not the shorts, the shorts said, you know what. Now you buy it. No, you don't just reach in and buy it. But you start to say, I now have a change in bias. The best way to predict, the best bias you could ever have is changing one that's already present. The best bias you could ever have is one that's changing one that's already present. The skill isn't creating biases, it's changing them. So if we take this chart over, the market goes up. I only pulled out examples that worked. No, I'm just joking. So the swing high gets taken out, the market finds some buy stops. You think that it stayed there, came back, tested those buy stops, and that was just coincidental? Of course not. Market kept rallying. This is high probability. We're going to find ones where it doesn't work. That's going to be obvious. Nothing's 100%. High probability that it's going to be hard to buy this thing here, 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 even though it worked, here, even though it worked. But once you could buy it, once it comes back after the holy you-know-what moment came out, there's a probability that there's a reversal about to take place. All right? Again, this is crude oil. So then the market just chops around. There's no obvious direction. There's an obvious direction. If you just look at this market, and take a fragment of it out from like here, just look at this market from there to here. It went up, right? It doesn't have to be a trend, by the way. Just because I say it has to be obviously bullish or bearish doesn't mean it has to be that trend look to a chart pattern. It just has to be a move. All right, this is a move up. Johnny could see that it's a strong move up. It rallied almost 100 ticks from here to here. That's a good move in crude oil over the course of an hour. And all right, it's strong. Market comes back down. Let's get rid of some of these drawings. Market comes back down, sets in a swing low right in here. Great. Market doesn't get above that swing high. So what's the dynamic in play here? The dynamic is people are stuck long from here, even though it's a winner, from here, even though it's a winner, from here, even though it's a loser. And it didn't go and fulfill them by going through the recent high, which is right there. Market starts to creep lower. That's a moment where biases start to change in there. Do you just sell it there and all is good? No, you can't just sell it there and all is good. But your idea started to change. Your bullishness started to change, and the probability of some downside was real. And if you could find places to sell it on a pullback, there's a lot of drawings on here. Bullish up move, pullback works. Failure to make higher highs. Swing low gets taken out in here. Pullback. Probability for downside because this swing low was taken out is intact. A way to predict where not only sell stops might be, but also where a change in bias might be happening. Now, this is a lot of overnight crap here, to be honest with you, in crude. And we get a big move like after 8 o'clock. Now, here's a move that kind of didn't change the bias, so it's something that where it doesn't always work. This is, if you look at this chart from this area to here, all right, between those two brackets, it's pretty downside, right? It's after the 8 o'clock open when crude starts to get busy, right? It breaks a full dollar. It's bearish. It takes out this swing high right in here, right? Comes back down, but it cannot turn and start headed north. But if you think about it, look how much time that it gave you to say, you know what, this is like an hour and it hasn't went back north. You have to start scratching your head again. It's like anything else. The longer you have an opinion and a trade on, the longer it's not working, the less likely it might actually work and the more risk you're taking. But they took this swing high out, came right back, couldn't reverse course. But it did take a while to continue to the downside. Let's get a nice, again, we got to get into obvious. If you just tighten this up like this, obvious moves or strength, this is a pretty decent bullish move from there all the way up to here, correct? And we open up at 8 o'clock Central Time, by the way, right? Crude oil opens up at that time. That's like the 8:30 open in the ES Central. Market starts to take out some swing lows in here and in there, right? And it starts to fail. It doesn't no longer make a higher high. It kept making higher highs all through here. Now it doesn't make a higher high. Takes out another swing low. So it starts to give you back. Let me get rid of all this. Back when this swing low and this swing low are taken out, it starts to get you to scratch your head that this high might be the high. It might be a pullback and then some downside, and that's what there was. This isn't going to give you exact trades. You're going to have to come back in and say, here's a good one too. But you're going to have to come back in and then use the things like good support resistance, thin spots, where a big buyer or seller came in to sell back up against. That's what's important with trading a bias is, first off, the best bias to trade is one that recently changed. And then the final location based on the footprint, based on a big order, based on also understanding where you're going to get out before you get in. Let me say that again, where you're going to get out before you get in. That's a good location for you to be able to manage your risk. It's not necessarily a good location in and of itself. Just by knowing where you're going to get out before you get in is make it a good location. It doesn't make it more probable that you're going to manage your risk better and that you're going to be paralyzed, right? A lot of people don't have a plan to get out, exit strategy, hold on to stuff too long. Everything's a surprise. As soon as you open a position, if you have too many decisions to make, they're probably not going to be great. So you kind of want a real good idea what you're going to do before you open the position. Before you open the position, you should know where you're going to get out before you get in. That's part of selecting a good location. The first moment, if you guys look at this chart from here to here, the first moment that this rally was in question, in my opinion, would have been when this swing low got taken out. That made people say, the ones who know what they're doing and the ones who are long, transitional moment. A swing low that's taken out after a nice move up, or a swing high that's taken out after a nice move down. Those are two things you could write down. A swing low that's taken out after a nice move up, a swing high that's taken out after a nice move down. Starts to help you change your bias and create a transitional moment. Let's move fast forward as this market just didn't show a whole heck of a lot. This is overnight where my cursor is. Grabbed a bid couple different times. I would say this is a decent down move. As soon as you started taking out swing highs, the reversal happened. Where my cursor is right there is a big transitional moment that led to a 150 tick rally or $1.50. Nice move from 51.50 to 53. So right now we're kind of in an uptrend. I think the little Johnnies of the world will try to buy it. Where is little Johnny probably wrong? I would say if these swing lows get taken out quickly, though. If these get taken out, it's too late. It's already moved lower. So I like to see these swing lows to be a little bit more defined, which means have it run up a little bit and then, a swing low that looks more like that. Either way, I don't know about you, but if I was long, I wouldn't want to see these consolidation lows get taken out, especially if they zip through it like that. Then they're probably going to come back up, test the middle of this consolidation, and then walk down to the bottom of this one, and then walk down to the bottom of that one. These are the technicals when you're looking at chart patterns you should be focused on. Laying the logic in the pattern, right? Laying the emotion in the pattern. What are people thinking? It's safe to assume there's always a lot of people long and short. There's probably more people long. That's been the buying that's created this move up. And then it's going to exhaust itself when everybody who wanted to buy it already bought it. Think about that. Uptrends exhaust themselves when everybody who wanted to buy it already bought it, and now they have to sell it. They'd be lagging, right, Chris? This is why this thought process is actually a skill and a leading indicator, because Chris, who's newer to the edge, accurately says that's where all the MACD and stochastic stuff and all these other indicators wouldn't have given you a signal yet. And then when they do give you a signal, this signal's already come and gone, meaning a nice swing low after an uptrend has been taken out. That's your first signal that the downside is in. And then everything else lags behind. And that's where you get frustrated, is once those signals tell you that the market's going to reverse, the market already reversed. Or at least the opportunity to get on the other side is already come and gone. So this is real time, by the way. It's trading 52, 88, 89. I would think that you'd get worried in a real time now below 52.78. You see these consolidation lows, another 10 cents lower. You'd really like to see them run it quick, come back up, chance to sell it around 75, 85, risk above the highs to see these swing lows get taken out. You see how that could, how short-term analysis could give you a longer time frame type trade? Markets like crude oil, markets like gold they trend more than the S&P does. All right. Now let's look at a different time frame, get that chart out of the way, and open up a 30-minute chart of the S&Ps. All right. So this market has a big uptrend, and no swing lows have really been taken out. If the bears had any hope, I mean, this isn't swing lows, overnight chop. This is like uneventful. Like it just didn't happen, you could almost say. When it's that 4-point chop, there's no move, there's no real value in saying, okay, it broke above there or below there necessarily. But when it's this tight, if you get good overnight volume or action, then the overnight means more. If you want to know what means more, the more volume happens overnight, the more meaningful the prices that traded overnight are going to be. There's no point is, yesterday there was no real reason to reverse trend. And remember, this is a 30-minute, right? This is a 30-minute. You could say before they opened, this little swing low was taken out in here before the open. But after that, everything just kind of ran up. And then it gives you time, if you're wrong, to get the heck out. That you got these swing lows needed to get taken out, they didn't. These swing lows needed to get taken out, they didn't. These swing lows need to get taken out, they didn't. I don't even see good swing lows on a 30-minute that would need to get taken out. And that's the definition of a grind. Now, we could go to when the markets were a bit busier. And you could see, remember, these are not 10 PNFs or anything like oil. These are 30-minute candlesticks. But take a look at right in here. This market is bullish in here, takes out this swing low, and for the next couple hours runs down. This market takes out this swing low, and for the next couple hours doesn't go down, but doesn't go up either until they take out the top of that consolidation. I'm just trying to give people a sense of, on a 30-minute, when to see. You really want a cleaner swing high or swing low. This is a 30-minute candlestick or bar to get taken out in order to start changing your bias. You want to see good clean direction and then that swing low to get taken out. Let's change this to a 15-minute. All right. Here's a good example of longer term a swing. This is a downtrend right in here, right? First swing high to get taken out. Did what? Reversed course. Market ran up 20 points from there to here. Doesn't look like much, but it's quite a decent rally. Came right back down pretty much where the shorts tried to get out inside that circle. Probably held right in there too. Again, do you want a clean swing high or swing low? So this starts to be an uptrend, although it's just flat, right? It's just kind of flat. Just get something that's cleaner. Now here's one that's clean but doesn't work but gives you a lot of time. This is overnight stuff also, so just keep that. This market goes up, comes off a little bit, walks up, comes off, goes up, make higher highs. Looks pretty strong, right? We're just looking from this bracket to this bracket. So the market starts coming down. First swing low it takes out is down in here. You're like, okay, we got a chance to change the bias and a reversal. Doesn't retrace much, and it takes forever to continue lower. We don't want to be in forever trades. The market has to go up or down. It rallies. There's probably some news also that pushed us north. Another thing is none of this matters when there's good fundamental news that's driving the market. Nothing else matters. Keep that in mind. You're going to shift course no matter what. And if you can line up a couple where, let's say, here's what's really professional about trading geopolitical events is when you can line up where, let's say, some shorts are in trouble and it's a bullish geopolitical event. Think about that. You got short stuck and you got something fundamentally that's bullish. That's really going to extend the pop or the rally into that instrument because of that event. You had shorts that were nervous, they were ready to buy in anyways, and then wham, you had this influx of people wanting and needing to buy because of the event that just crossed the wire. Big swing low that got taken out right in here, changed course. Instead of an uptrend, market turned around and had a little bit of had some downside. Now we just tighten it up here. Take it to a 5-minute. Just looking for some decent. This is a nice downtrend. First swing high that gets taken out was a gap open higher, but it did reverse to the upside. You're going to look at a decent move down. Now, it looks different when I open up these things. Here's a good move down. I don't want to go over example. The real skill will come in the exercise I'm going to talk about in a second. But this move down is bearish, right? That's a swing high. That's a swing high. When you start taking out those swing highs, the market's going to change. And it does. And it's a good way to just take back what I was saying, the 4 questions. Is it bullish, bearish? It's bullish. It's obvious. All the little Johnnies in the world want to do what? Buy it. Fine. Where are they wrong? Because when it's obvious to a 5th grader, it's obvious to the rest of the world, and the rest of the world want to buy it. The rest of the world does buy it. The rest of the world has to get out. And when the rest of the world is wrong is where there's opportunity, and the best way to create your bias is when others are too late in changing theirs. Let me introduce a couple of Confluence videos from yesterday, then you guys can go and watch them. I uploaded them to the Trading Cabinet. For you guys that are new to the Edge, the Trading Cabinet is the last on the Track 3 portal. Don't just watch a bunch of them, although you can. It's better to watch them after the applicable coaching session that we introduce them. I don't like to replay them in this venue because they already have a voiceover to them. They'll run better. You'll be able to see them better if you do it on your own. But I just wanted to introduce these two real quick. Let me stop the recording a second, and I'll pick right back up on it. Just to make sure everybody's on the same page here. You're in your Track 3 portal, okay? If you're obviously logged in, make sure you're logged in. You'll see the yellow register button and everything. But go down to the bottom, and it's this Trading Cabinet, Files of Order Flow Clips. Click on it. The top two, the most recent, and this might be tough to understand, but the most recent is the top one. For the coaching sessions, the most recent isn't the top one. But in these trading clips, the most recent is the top one. So the DAX leaps and leads the ES. Another way to find good locations after you've changed your bias is a leader. It's an ancillary. Watch this video. See when this jumps, how this walked up. If you were bullish, even if you weren't, how it could have gotten you bullish, because it led this thing up a couple points. The next one. This one was from yesterday. It's a longer one. Watch it a dozen times, even if it seems simple to you. With the Confluence, how treasuries were I believe, bearish, and the DAX and order flow all came together to give you what was the near term and ended up long term right side of the market. These two clips. I've got more and we'll continue to freshen this up, but there's a lot of these videos as you go down, and as I get more and more, I'll cluster them into categories, like leaning on a price, seeing a big order come in. These things I see naturally, just like you having years of seeing them, and now you've got almost with these clips, you're starting to get the frequency and the repetition of seeing it, saving you months and years of screen time, because you're going to be able to just replay the event over and over and over again. Another Chris in the room that's been with us a while says he's watched all 20 clips yesterday and they're a really big help, exclamation mark. They're going to be a big help. They're not going to hurt you, trust me. But you got to put an exercise after it. What do I mean by that? So this event today where we just went over, on these charts, when things are slow, look at a faster market like the Russell. Put it on a periodicity that shows you a bullish or bearish kind of move it's in. And ask yourself, where are these guys going to start changing their mind? What has to get taken out? And then you see the prediction work, it doesn't feel like a guess because it wasn't a guess. You actually attached logic to the next move, not math. When you see big buyers coming in and it does move it up in these clips, it don't seem like it's a guess anymore. It's order flow. So watch them, and there's just content never ends in this, but you got to use it. You got to practice, especially on days like today where it's just a drift. Any questions before I wrap it up? Attach exercises. This one I don't have a specific one, that I could test you on because it's something that has to develop. Next week, for the first 5 minutes of next week's session, Drew is going to, and I don't want to spend any more than 5 minutes, do a quick test to see how he's doing. See if we can't trip him up in executing on his dome to see how good he is under pressure. All right, Tom. Good to hear. I'm going to stop recording for those watching it on a recording. This will be the end of it.